Hey everybody, this is Jose Blasco. We are about to get started, as you can see with the countdown. Time to begin. Welcome to the session, everybody. Today is April 14, 2022. This is Jose Blasco. The session is Options with Options. We're going to spend around an hour looking at the options markets, making sure all we do is understood. We're going to be looking at new opportunities. We're going to be looking at trades that are currently running and talk about trade management and more. Before we get started, I'd like, as always, to highlight on the upper left side of the screen our financial disclaimer. So please read it carefully. This is important information. Make sure you don't rush it. Read it completely. I'm counting on you to do that because, as I just said, it is important information. I did not request for a sound check today, now that I'm thinking about it. So please go ahead and let me know if sound is good and everything is okay. That would be good for me to see. Let me do a quick double check on my end. One moment, just very quick here. Almost ready here. Okay. Got it. Yes, all good. Perfect. Okay, so let's continue. As I was saying, sorry for the mini break here. The session today will have us look at the market environment, look at trades that may be running at this moment in time, and we'll review them. And from there, we will get into ideally finding new opportunities. We are spending an hour to do all of this, so the latest part of new opportunities may be a little bit of a challenge today because we may have multiple roles to be executed and so on. And we'll see. I'll do my best. Okay. Give me one last moment, if you don't mind. I'm just gonna mute myself for a second here, guys. Okay, just one moment, please. Okay, everyone. So I'm back. I believe things are back to normal. Jeff, how are you, my friend? I was sensing that maybe there was something that was not totally normal with the stream, but I believe that things are normal. Okay, so let's go ahead and continue. I'll close the introduction slide. I wanted to point at our question page. The way you get there is by typing tradewithufos.com/Jose. And when you come in here, what's handy is that in the bottom part, we have this question section where you can look for answers by typing a question. And if the answers are not found, then you can pose your own question by clicking on the green button. And then our support team will get back to you, even though any member of the community is also welcome to participate of those comments. And basically this is teamwork, while obviously we are, let's call it, responsible for it, if you wish, in the sense that we're going to be on top of it, but for sure anyone is welcome to participate. Anyway, so here's the S&P 500. Okay, and we are now going to get into it when it comes to market analysis. Christian, how are you? Good to see you. And what we can see with the S&P 500 is that the condition that we described last week of having a red climate that was likely statistically going to reach its end, well, guess what? That climate did not reach its end, and since the last week, the market kept continue falling, even though for all these days, okay, all these days you can see here, okay, all this period of time, the implied volatility of the calls has been greater than the implied volatility of the puts. So to be honest, while the climate continued its duration to the downside, if you look at where the market was, a few days ago, somewhere in the middle of last week, okay, I think we met around that day, or maybe I'm not sure which day it was. Okay, but let's say here, if you look at where the market is, it's basically at the same level. So we had a little bit extra continuation on the climate, but given the fact that the calls are above the puts, there is buying pressure in the market, which has created this market to go sideways for 4 days in a row, 4 trading days, which is more than 4. And again, statistically speaking, we are indeed approaching a change of climate, and from there we should be back into an up climate, 6 candles at a time, and that's what we have. Okay, so yeah, also if you were looking at the charts a little earlier in the day, around when the market opened, the daily time frame of the S&P had an indication for an Elliott wave turning point right here. Okay, that indication went away as the price of the S&P started going lower during the trading session. But keep in mind that if the price goes back up before the close of the day, not only we are now very close to a change of climate, on top of that, we are going to have an Elliott wave turning point. And again, all of those are odds for the market to start moving higher, supported as well by the implied volatility of the calls, blue color being above the implied volatility of the puts, gray color. Okay, so this is the market situation we have. Again, patience. Okay, traders means being patient. Okay, we need to wait for the right time to take the trade. Not like all the trades are going to be perfect, because we cannot predict the future. But the right time in this sense means wait for a little bit more of an evidence where the red dot changes to blue, and now being aggressively bullish would make sense. Where being bearish now doesn't make sense from a statistical point of view, because this climate has been running for 7 candles where statistics suggest 3. So while it could keep falling, it's not likely from a statistical point of view, and therefore we should not get there. Okay, so again, very similar environment compared to last week, where the classical approach here, if you had no trades in your account and you want to add something, would be to use non-directional trading strategies today. If tomorrow, let's say, the climate has changed, or the day after the climate has changed, then you would certainly want to start being directional, in this case to the upside. But in this sense, it's just a bit too early. Okay, we will be too fast when taking that action. Mark, it's good to see you. Ahmed, it's very good to see you as well, my friends. Very nice, everybody. Okay, so what else we have? Well, again, from a volume map point of view, we can see, first of all, implied volatility of the calls and the puts are equal during the intraday session, even though as an average, calls is winning. And during the session as well, we can see a little bit of an extra bias on the call side, very tiny, not too relevant. But what's very nice to see, though, is that we are surpassing the call volume in basically all expiration dates. We are also surpassing the put. So that expiration and that expiration kind of neutralize each other. But in that one, you can see how we went way above the average on the call side, which is not the case with the put side, where we are just barely getting to the average. And on the next expiration date, we are above the average, and the put is not either. So with all of this said, we can see that throughout expirations, okay, all the way to April 22nd, we can see that there is this bias of calls becoming the protagonist, which is also seen clearly here. Okay, so again, too soon to act, to be aggressively bullish, but the moment we have a climate change, based on the process, the tools, the methodology I employ, I illustrate when we do the sessions, it's going to be time to act. Okay, so we need to have a little bit more patience. It seems that it's very close now. So far, we'll be dealing with our non-directional trade, which it's a fantastic way on how to trade too, even though, of course, you make more money on catching a move and riding the move. You make money faster, I should say, that on trading non-directionally. But trading non-directionally is a fantastic way to make money while you wait for the right time to get directional, isn't it? So again, and also you add diversity in your portfolio. So anyway, this is the analysis of the S&P. Let's take a look at the VIX. Another one. The VIX is the bottom one on my list. So when it comes to the VIX, the market, it's not scaring too many people today. The VIX is down by 1.83%. So we are talking about VIX 21. It's not too low, it's not too high. To be honest, it's not ideal to do non-directional trades. It's better when it's higher, right? Or when it's lower. When it's very low, we love to do the double calendars. When it's very high, we love to do the iron condors. So right now, it's kind of like somewhere in the middle. It's not too high, it's not too low. So what do we do? Well, this is when really the UFOs have a lot of relevance. If you look at where are the red UFOs, they are here, 22, 23, whereas the green UFO is down there at 19. So just visually speaking, you can see that if the volatility rises, it's likely going to fall. And if volatility falls, there is a lot of room for volatility to fall more until it rises back. And in other words, if I was to give it a priority, and please feel free to comment based on on prior sessions that we had and this question now. Let's see what your comments are going to be on the chat box. Okay. So what would you think with that market environment where we are closer to the red UFOs and the green UFOs? What do you think if I was to choose between being positive Vega or negative Vega, being doing double calendars, which are positive Vega, or doing iron condors, which are negative Vega? What would you say my choice is going to be? Iron condor or double calendar? Okay, because I just said it's not too high, it's not too low, so you could do any of them. But what would my preference be given the location of the UFOs? You guys tell me what you think. I'll check the chat box in just a moment. Mark, a very different options volume map at TradeStation. Let me refresh my screen again. Mark, we talked about this in prior sessions, isn't it? Many times. In my case, like is the case today, I am running versions of top which are not the one that you have installed because of all the various things that we do. So here you have it, and I would say just yeah. So I guess the values should be quite similar. Okay. So Christian, neither. Well, yes, I said it right because it's not too high, it's not too low. Neither is fine. But I have a preference. Okay. And Jeff said double calendar, and in this case, I'm gonna have to say that no, my preference would be the iron condor. Okay. Why? Because what's more likely going to happen? Oh, I'm like, why is that? Why don't I see it? Because I changed symbol. Let me go back to the VIX. So why would that be the case? Going back to the 55-minute time frame. Why? Because if I do an iron condor and volatility drops, which is good for the trade, there is plenty of room for volatility to drop, which is very good for the trade. But if it rallies, there is limited amount of room for volatility to rally, because when it gets to 22, it's going to tend to go back down. Why is this bad for the double calendar? Well, because the double calendar is a very sensitive Vega type of trade where we need volatility to go up. Remember, when we do the double calendars, we actually make them to line up with earnings reports precisely to catch the greatest possible increase of implied volatility. Well, if we got UFOs there, and those UFOs may allow volatility to rally from 21 something to 22 something, but when it gets to 22 something, then it falls, then the double calendars will not perform well at all. Right? So that's why my preference in a situation like this would be to do the iron condors, because even if volatility rallies, is not going to kill me, because we make more money on time decay that volatility volatility falling, but definitely volatility falls a lot, so that's going to help the condor too. Okay, so that's the reason why. Anyway, so let's review our positions now. Okay, we're going to start with GE. This is the first trade we're going to review. This trade expires on the 29th. Okay, so we have a little bit of work to do here. So GE is going to be here. Here we go. Here is GE. So as you can see, if I compress the chart a bit, we are still within the range that we had predefined. Okay, so nothing is strange at the moment. If we look at the risk graph, what do we have? Well, so if we look at the risk graph in this position at this moment in time, it seems that the real-time PNL of the trade is $11. Okay, but if we wait all the way to expiration, which is April 29, and we were to do nothing, actually April 14, this is the date that is being used at this moment in time. If we were to do nothing, we would lose around $40. Okay, so $40.56. Okay, something like that. So that would be the PNL. But again, we are not going to do that, right? Because we still have another role to do, and earnings for that stock are going to be happening on April 26. Okay, and we can see already okay, that volatility started going up, 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 we may get volatility to rally much more. And again, if you recall, if I take that 34 volatility and I make it higher, notice what just happened now. Now you are in the profit zone, okay? So again, this is what we're looking for. But before we get to experience that rise in volatility, getting into earnings, we still have one more roll to do to the next expiration date, okay? And in order to evaluate if this is the right time or not, we're going to be looking at the option chain. I'm only interested in evaluating next week, which is April 27, and this week, which is April 14. Why do I want to evaluate April 14? Just to see if my Greeks are distorted. Why? Because the moment the Greeks are distorted, I'm going to roll to the next expiration, which is April 22. Okay. And the strikes I'm interested here are 98 and 87. So I'm just going to check mark 87 and 98. And I'm going to make this one strike so I get less rows on the screen. Okay, and basically now we're going to be looking at the 87 put, see if the Greeks are distorted, and if so, roll. And we're going to be looking at the 98 call, see if the Greeks are distorted, and if not, roll. I didn't get filled on the April 14 expiration for the G98 call. Also not filled on the AMD call. Okay, so let me complete what I'm doing, Mark, and then I'll review what you said there and try to understand why, and we'll comment on that. In the meantime, if you don't mind to type on the chat box, how did you try to get the fill? Did you do it like manually? Did you have a limit order waiting at 15 cents? How was it? What was your process? I'd love to know more about that. Okay, so let's begin with the 98 call. Okay, and also to be visual, let me float all of this. I'll close this one. Okay, so we got the 98 and the 87. The current price is trading at 91. So we are more or less in the middle between the strikes. Okay, this is where we are at. So when looking at the 98 call, the current theta value is 3 cents. Okay, if you multiply this times 0 days, to be honest, is 1 because the expiration is tomorrow, Friday. So basically, you're going to make 3 cents, okay? But notice how the asking price is 1. So there is no way you can make 3 because the most available here is 1. So in other words, the calls are distorted, and rolling would be the right action to be taken, okay? Now, having said that, the 98 call seems to not to have, the one that expires in April 22nd, seems to not to have too much premium built in. It only shows us 5 cents or 6 cents. So may not be worth it to do it. Okay, we're gonna look at that in a moment and see what we get for the roll, and maybe we need to end up doing the same thing that we have done, in the prior weeks, which was just to let it expire and place an order next Monday at 15 cents, which on my side I've been getting filled on those. Okay, but I'd love to know more about your case, Mark, and so on. Oh yes, of course, Christian, you're absolutely right. Muscle memory, and also being in Asia, basically it's almost 12 a.m. here, so I'm already kind of thinking of the next date. So I was looking at number 0, thinking, it's Friday. Anyway, you are absolutely right. Thank you for that, Christian. And then on the 87 put, we got a similar situation where the theta for the 87 put is 6 cents. Obviously, we got an ask price of 2, so there's no way you can make 6 if the only thing left is 2. Okay, and on the next one you got 40 something to 38 cents. So definitely doing the roll here makes a lot of sense. Okay, and then the question is, can you do it? Can you do the roll? Will you get filled? Because it seems that there is no one is bidding. So we're gonna have to see that. Okay, I mean, we're gonna be the ones bidding to get out, so I guess we should be able to get filled at 2 cents at least. Okay, but let's find out. Okay, so let's go ahead and move into TOS. We're looking at G. So with G, just like you, Mark, I was not filled on the G. To be honest, I was confused. Which was the trade? It was AMD, right? Yes, with AMD I did. With AMD I got filled with a 124 call, okay, but with the GE I didn't. Okay. Yes, I hear you, Mark. I hear you, and I'm reading only HOG got filled. Got you. Got you. Perfect. I understand. So I mean that's the case. If volatility did not rise, then it was not worth it for you to get filled. It's a shame. You could have collected 15 cents. At the same time, it's not like you missed on, $5 of premium. You missed on 15 cents. So it's not the end of the world. You didn't pay commissions for that either. So it's fine. Okay, it's part of the plan. There will be times where you may not get filled. And it's not that big as a problem because typically that happens when the stock has moved by a decent amount in a certain direction, which means you are getting more from the other side. And also, normally when the stock moves by a certain amount in whatever direction, typically implied volatility also rallies, which is the case in G. So whatever put we're going to roll today will pay you more and kind of compensate for those 15 cents that you missed. So not being able to be filled at times, it's part of the process. You won't get filled every single time you won because the market is the boss, not us. Okay, but again, when that doesn't happen, it doesn't mean it's that bad. Okay. And Christian, you rolled a couple of days ago. Perfect. That was the right time to do it. I'm sure the Greeks were already started, especially having today as an expiration instead of tomorrow, Friday. The process that we see typically starting to happen on the Wednesdays, in this case, probably started happening on the Tuesdays, and you had the opportunity to do that. So good job, Christian, there by being on top of it and acting in a timely manner. Perfect. So anyway, so with G, okay, let's complete our call thing. So with G, we'd love to sell the 98 call. Actually, we don't need to wait until next week to place an order because there is nothing for it to expire. So we can actually place the order today, even though we won't get filled at 15 because the 98 call, sorry, not 14, 22. The 98 call, it's trading at 5 cents. So you won't get filled at 15, but you don't need to place a conditional order like we have done in the prior weeks. You can actually just place an order now. We'll make it good till cancel. So whenever it happens during the week, you'll be in. Okay. So we are selling one of the 98 calls with minimum 15 cents, good till cancel, send. Okay. And now the order is in the system waiting to get filled. Okay. Probably we won't get filled today. But again, if that market was to gap up on Monday, you may now get that. Okay. On the other side, now we need to look at the 87 put that expires in April 14, and we want to roll it. So we're going to create a rolling order. So we replace that 14 expiration put to be April 22nd expiration put, and that is supposed to bring in 38 cents of credit. So we're going to do that. Okay, we're going to do that. And it seems I just got filled. So wonderful. I'll take it. Okay, we got 40 cents. We paid one. So it's a total of 39 cents of credit. So let's document that inside top. Okay, so what did we do? So what we did is that we took the original trade that we had. Okay, we took that April 22nd, okay, April 14, and we placed an order for April 22nd. Okay, even though I did not get filled last week. So I remember last week adding 15 cents here, which I didn't get. So that 94 should be 15 cents less. But I just added new 15 cents this week. So I'm just going to leave it like that untouched because if I get filled, that 84 cents will be valid. And then for the 14 put, again, we are moving it to April 22nd. We just rolled it. That one was just rolled. So we got 117 already in. Let me bring a calculator. So we already got 117. We had to pay 1 to get out of that put. That leaves us in a position where we still have 116 of credit. And then we just collected new 40 cents, putting us in a position of new credit being 156. So when we do that, notice how the risk graph now changes again. Okay, if I maximize it, okay, it changes again. And notice now how the risk of the trade that was originally 189 now is 150. And again, we are exposed to the rise of volatility to be back into that green zone. Okay, and again, remember this graph, it's plotting up to April 14. If this was being plotted until April 22, the orange line would also go higher. What I care about is that my maximum pain is less. That's what I care about, and I'm still giving myself a chance for profitability, which would be then more. Okay, so we are done with this trade. Please confirm on the chat box if this is good. Should you try to sell the call on Monday? If you mean on GE, not on Monday, you should place the order now. Good till cancel for 15 cents, and maybe the market rally is hard before the end of the day and you get your 15 cents, or if not, on Monday or whenever it happens during next week. Okay, so you should have the order in now. No need to wait to Monday. The reason why we wait to Monday in prior cases is because you already had a 98 call expiring on Friday, and you had to let Friday happen, so that call is gone, and then on Monday, which is the next time possible after Friday, you sell a new one. But since you did not get filled on the 98 call, you don't have a 98 call now, so nothing stops you from selling a 98 call that expires on the next week now. Okay, actually, this should have been done a couple of days ago, as Christian said, and notice that instead of collecting 39 cents of credit like I did, you would have collected 89 cents of credit like Christian did, which is way more powerful. Okay, so again, the management that I'm doing, which most of the weeks we're meeting on the Thursdays, many times, my management is coming just a little late, and I'm okay with that because I have no problem to take more pain than whatever is needed as a pain. I have no problem because my key goal here is that you understand the process so you can replicate that by yourself. But obviously, if you apply the process at the right time, in the right time meaning the right time being when the Greeks are distorted, right? When theta is distorted, you apply the process, you will get more premium, and you will be in a more advantageous position. Christian here would be now, if Christian had collected $89 and the maximum risk was 189, so now his risk instead of 150 would be 100. Okay, 189 minus 89 is 100. So it would be more efficient. And if every week you had been a bit more efficient than me, you may be basically risk-free now or very close to risk-free, which is the goal, okay? And then you get the rise of volatility into earnings, and that's your profit. So we'll keep repeating the process so you guys understand that. So far, I see on the chat box it's good, so happy to see. But if you have questions, make sure that you let me know, okay? So we are done with GE, okay? And as we are done with GE, we're gonna move to the next trade. Oh, wait a minute. I went too fast. Yes, I went too fast. Sorry, guys. I need to take this again because I need to document this, isn't it? Okay, let me do it here. So I'm going to go ahead and do this. We did April 22nd, and then we did, what was it? 156. 156. Here we go. So right click, copy. Let's go to the positions, and we'll plug in GE right here. Perfect. Next trade in line is Harley Davidson, okay, which expires in April 22nd. Okay, so that one it's different. Okay, that one is different because April 22nd is next week. Okay, so the treatment of this trade has to be different. So let me open the risk graph and float it. Let me take a look at HOG so we understand what's happening to that stock. Okay, so that stock is somewhere in the middle of the range. Okay, between 40 and 34, 35. So again, we are still basically doing what we're doing. We're basically where we entered. We entered right here at 37.95 or something like that. Now it's trading at 38.38, just a little bit above the entry. But the one thing that happened, if you look at where the implied volatility was when we started, which was 47, now the implied volatility is 54. Okay, so we are catching an increase in implied volatility while we are traveling into earnings, which, bad news, have been changed to April 27. Okay, bad news from a trading point of view, bad news, because we were counting on earnings to happen before the 22nd. They pushed it by a week. Okay, so bad news, but good news, because these things happen, in my experience, around 40% of the times or so. Earnings dates change. So when that happens, what do you do? So good news, from a training point of view, this is a case that we have not seen often in the sessions. If any, around 40% of the times we've seen it. We've seen it before, but not that often. And therefore, we need to comment on what to do here. Okay, what to do here. And basically, you have two alternatives. Okay, you basically have two different alternatives, which we are going to be discussing in a moment. Okay, so let me bring in the information first. Okay, so we have HOG. Okay, so we have our April 22nd, April 14. We got calls, we got puts, we got both. Very, very good. Perfect. Okay, so again, the classical approach would be to roll, right? Would be to roll. So let me explain this a bit better. We have 40 and 35. Okay, no 34. So we got 35. Okay, so the classical approach would be to roll, and to roll means that you would take your 40 call that you're long that expires next week on April 22nd, and you would take that 35 put that expires on April 22nd, and you would leave them alone as always, and then you would take the 40 call that expires today, and you would take the 35 put that expire today, and then you would roll them, meaning that you would sell a new 40 call expiring on April 22, and you would sell a new 35 put expiring on April 22. But you cannot do that, because selling the 40 call that expires on April 22 basically closes your 40 call long, because it's the same strike and the same expiration date. And same happens with the 35 put. If you sell the 35 put, right, that expires on the same expiration date, well, it neutralizes each other, because basically selling the put that you own basically closes the trade you have. So you would be out of the trade if you do it now. Okay, and again, this is an option. Okay, this is an option to do that. Currently, if you look at the P&L of this trade, we are basically breaking even. So you may tell me, look, if the stock stays where it is, I just wait until the expiration date today, a little later in the day, I'm going to be making around, $18. So I'll wait a little bit, collect just a little bit more time decay before the market closes today, and before the close, I'm just going to get out of the whole thing, and that's it. It's over. You could do that, okay? But that's not the point, or that was not the plan. The plan was to catch the rise of implied volatility. Okay. Now, what's the problem? The problem is that they moved the earnings by a week, so now it's going to be challenging to catch the rise of volatility, right? So again, what's the normal approach? Well, the normal approach is you have your 35 put, you have your 40 call. The normal approach on the last week was to take the double calendar and diagonalize it. Remember that we talked about that the other day. That means that you would sell the 41 call, okay, and you would sell the 34 put, right? So one strike below, one strike above, that's what you sell, okay? And when you do that, what happens? Well, let's simulate it so you understand the outcome of doing that. So I'm going to compare spreads, copy the primary spread. And so what I'm going to do is I'm going to, first of all, emulate that I am getting rid of the April 14 35 put and 40 call. So the options that expire today, let's pretend I'm going to close them at the midpoint. Okay, so I buy to close the 35 put, I'm short. I buy to close the 40 call, I'm short. And I add two more legs to sell April 22nd expiration. And what I'm going to sell is the 41 call, and I'm going to sell the 34 put. Okay? So by adding these four rows, all with a midpoint, I am emulating closing my two options that expire today and entering new options that expire next week, one strike above the call, one strike below the put, which is what I just explained with the writing. So if you do that, what happens? What's the difference with the risk profile? Okay. So the risk profile now looks like that. Okay, looks like that. Where if the stock moves either up or down, here we go. If the stock moves either up or down, so you're gonna make $50. Okay. Now, if the stock stays basically where it is, worst case is right here, and that means that you will lose $17. Okay. If volatility was to increase a bit, okay, you won't make more than this amount. Why? Because since you are selling one strike above, the most you can make is the distance between strikes. Okay, so even if volatility rises, you won't make more. Now, if volatility rises, you will lose less. Okay, so it's okay. Okay, now this trade, it's slightly disappointing from the point of view of premium collected, because the normal thing that happens is that you end up with this type of risk profile, with the orange one, but everything is above the zero line. That's what normally happens. In this case, it's not happening. Why? Because they pushed the earnings 1 week later, and therefore, what happened to the April 22nd expiration we are long? What happened to those options? They did not gain much in implied volatility. And because they did not gain much implied volatility, when I sell the 41 call now, and when I sell the 34 put now, it's like I'm selling the front week. It's not like I'm selling options that are lining up with the earnings dates where the earnings are priced in. Not anymore, right? So therefore, I get less premium, and therefore, I still have those $17 of potential risk as a worst case situation. Again, not the end of the world. And if you leave it like that, look, end of the story. You make 50 per contract, or you lose 17. It's a good reward to risk ratio. They change the date, which hurt the trade, and still in the end you end up with maximum losing $17 per contract versus a profit of 50. Is not bad. Okay, but let's explore if there is another alternative. Okay, let's explore and see if there is another alternative. Okay, if you close it today, you're gonna make, if you wait a little later in the day, around $18 minus commissions. If instead of closing it at the end of today, you sell the 41 call and the 34 put next week, then it's either you lose 17 or you make 50. That's the second alternative. Okay. What would a third alternative be? Anyone? While I take a sip of water, anyone would like to share your thoughts of what may be an alternative opportunity? I'll wait a second, getting you thinking there, guys. Most of the sessions, I'm telling you what to do, at least based on my rules and my trading plan, my preferences, and everything else. But also, I like you guys to think a little bit and come up with ideas, because there'll be times where you're trading options and something happens and you have to take a decision. And again, getting you thinking in a case like today, I would say is healthy. So do not be shy. Remember, while we're using YouTube as a streaming engine, this is an unlisted stream. The stream will be then posted for the recordings to be accessible for others and yourself, but the chat box won't. Okay, so this is a chat between us. Only us live here are able to see this, and therefore there is no reason to be shy. We're here to learn. Give me your alternatives. What do you think could be done? Okay. I'll give you a clue. For me to decide if something can be done or not, I'm going to have to look at the skew. Okay? That's what I'm going to be looking into. I'm going to look at what's the volatility level on April 22nd, which is next week, and what is the volatility level on April 29, which is when the earnings take place. Okay? Now, notice what's happening. Okay, notice what's happening with April 29. This is the problem. With April 29 expiration, we are dealing with 60% implied volatility. With the April 22nd, we are dealing with 37% volatility. If they had not changed the dates, the red line we'd be pointing at 60% volatility. And by selling those options, the 41 call and the 34 put today with 60% vol, it would have been amazing. But again, they changed the date. Okay, so they basically killed us there. Okay, we were doing it perfectly, and next thing you know, they changed it. And by the way, I expect this to happen again. 40% of the times in my experience, it happens. Okay, Mark, let the April 14 calls and puts expire. Well, if you let them expire, then basically you're gonna find yourself long a strangle next week, which will expire before the earnings report. So that strangle will very, very likely then end up creating a loss for you, and you would end up basically not making more. So again, if assuming the Greeks are distorted, those April 14 expiration options need to be rolled. We need to do something about them. Okay. Now the question, basically, what I'm trying to solve here is: should we go for option number one, close the whole thing today? Should we go for option number two, which is to sell the 41 call and sell the 34 put? Okay, using April 22nd, and the trade ends on April 22nd, even though earnings are on the 29th, and then you may either lose 17 or you may make 56 or 50, right? So that was case number two. Or option three, should we roll the April 22 options to the next expiration date? Should we do that? Okay, that's the other possibility for an alternative. Okay, but I want to explain that better in a moment. Okay, so roll the whole trade out to 29 expiration. Okay, this could be a possibility. We're gonna look at this now. You exited XHG already collecting a net gain of $50. Good done, well done. But it was accidental because I mixed up puts and calls. Have to say TOS is not easy for double calendars. Will use Schwab in the future. Got you. I understand. Well, in the end, it's all about repetition, Christian. When you do it, let's say 20 times, no matter the platform, even if it's a complex platform like IB, then it's muscle memory. Okay, so the key is that you repeat it a few times, so you don't make those mistakes. It happens to all of us, my friends. Okay, so these things are normal. The graph, column, and rows are not easy to use either. Needs visual massaging. The graph, columns, and rows. I'm not sure what you mean there, Christian. I'm sorry to say. If you could explain that to me, I would understand. Do you mean the graph that we have on the right with the maximum loss, the maximum reward? I don't know what is the row and the column. If you could explain that to me, okay? Anyway, so what do we have? With April 22nd, we are talking about around 30% volatility. With April 29, around 60. With May 6, we are talking about around 52. Okay? So those are the three choices I'm putting on the screen, because obviously I don't want to now give this trade another month of duration and use June 17 expiration options. That makes no sense because we don't have an earnings report there. Remember, the whole principle behind this trade was to make a profit out of the rise of volatility was the issue. While we made some profit thanks to that, next thing you know, the red line, which is the April 22nd, got basically killed because they have changed the date for earnings. Okay, so what do we do? Okay, well, the option is to actually move the April 22nd to a future date. But which date should that be? Should I use the date after the earnings, which is May 6th? Or should I use the date of the earnings themselves, which is April 29? Okay, well, it's difficult to say. We need to simulate it, especially because in many other cases, and you can see it here. So with a red color, this is something that you need to evaluate each case because each case will be different. So you can see how the distribution of volatility for the red color, which is April 22nd expiration, follows the pattern of what is commonly known as a volatility smile, where the other two above are much more just going down. Okay, this one actually almost looks a little bit like a frown, if you wish, kind of, not exactly. Here a bit. Okay, that's why I said it's a little bit like a frown. The green one is much more like flat line going down. So if since we're not going to use the current strike, we're going to be using 35, which is here. We're going to be using 40, which is here. So there are cases where, if the red line or the blue line was to have a particular shape, okay? So let's say, for example, the blue line. Let me delete here. I got too much drawing. Let's say the blue line has a smile shape. And let's say the green line has a frown shape. So what could you do? Well, I would be very happy to buy options on the 29 and sell options on the 20 on the 20 sorry, buy options on May 6 and sell options on April 29. Why? Because I will get more volatility for the ones I sell, and I will pay less volatility for the ones I buy, if the shape of the volatility distribution was like that. But in this case, it's not the case. In this case, the graphs are very similar. So if maybe there is some sort of a price anomaly in some strike, that may benefit us, but you wouldn't know unless you simulate it. So let's go ahead and simulate it, okay? Let me see, Christian, where you do the math in the risk graph, editing the spreads on an ongoing basis. I need calendars, bigger fonts and colors. Got you. I understand. Well, one setting you may want to explore, Christian, is when you use Windows and you have your settings here, and you look at your where is it? For whatever reason, I don't see it now, and I'm sure it's in front of me, right? So, oh my God. Okay, I want to talk about options, not about Windows, but give me a second, guys. Why is it that I don't see it? Give me a second, guys. Give me a moment. Okay, so now you have in front of you Jose Stubborn. Okay. Okay, here. I don't know. Yeah, I guess it was in front of me and I was not seeing it. I don't know why. Here. So inside your screen, there is something called scale, right? So when you select your resolution, right, you also have the possibility to select a specific scale that changes the size of text, apps, and other items. So I would suggest that you take a look at this, Christian, and you change it to other values and see how you feel about that. You can do this per monitor, so each of your monitors could have a different scale and a different resolution as well, and hopefully that helps you to find the settings that are more comfortable for you. Okay, cool. Okay, so let's go back to this. Okay, and we are doing the analysis here. Okay, so I'm just gonna get another. I'm gonna get two more copies of the primary spread. Let me go back to 54.37, which is where we are. And what we're going to do now is that we're going to work on this one, the one which is pink, or fuchsia, I should say. And the first thing that we're going to do is, same as before, we're going to add two orders to close the ones that expire in 14. Okay? So this is 35 put and 40 call. So we're going to close them at the midpoint. Okay? But if I'm going to roll the whole thing, okay, if I'm going to roll the whole thing, we could also, and we may also want to evaluate, I'm going to add 4 more legs using April 29. Well, yeah, actually I cannot do that because I got maximum 8 legs that fit in here, and I will need more. So, okay, let me do some math. So if I close the 14, okay, if I close the 14, that would pay me 5 cents each. Okay, 5 cents each. So if I close them, it's equivalent to, I made 70 minus 5. 75 minus 5 is 70. I made 65 minus 5 is 60. Okay, so I'm just going to remove this. And I'm going to make this to be April 20. No, I'm going to do it like that. And then the April 22nd, I'm going to emulate that I'm closing them. To close them, I'm going to have to sell them. So I'm selling the 35 at the midpoint. And I am selling the 40 at the midpoint. But I'm going to do it twice. Because what I want to do is currently, and this, it's a bit confusing, but hopefully as I write it down, it will be clarified. So currently you have the 35 put and the 40 call. What I'm trying to do, because the ones I currently have are April 22nd expiration, the ones that I'm long, okay? And I want to substitute those April 22nd expiration to become April 29 expiration. Okay, so April 29. So for me to end up in the same position, I will want my April 29 expiration 45 put, and that, by the way, should be a 3. Sorry for that. So it should be 35. I'm not going to write it down. Okay, this is terrible. Sorry for that. But basically, what you would want is that 29 of April expiration put to be together with the short 35 put on April 22. Okay, so you got 29, 22. That's what you want to do. Same strike, 35, 35, but you want 29, 22. So in other words, you need to move from being long the April 29, 35 put to being short one. That's why I'm going to sell 2. Because if I sell 2, basically the one I'm long, I get rid of it. And with the other unit, I end up short 1. Okay, so this is what I'm doing. If the screen is distorted on your computer, click on the settings wheel on the bottom part of your video player, and you will have the settings wheel where you can select the resolution. Just select Full HD, and you should be fine. Okay, you too, Christian, are having this problem? Everything looks normal on my end. Guys, everything looks absolutely normal on my end. You can see me fine, but not the screen. Okay, let me try to do this just in case. I'm not sure if this has helped or not, but in any case, if you are not seeing it right, please check that settings wheel with the video resolution select 1080p. Okay, let me re-explain all of this, okay, because it's confusing enough to not to re-explain it, especially after this interruption with the video screen. Please confirm to me quickly on the chat box that you see me well now, because if I explain it again and you don't see the figures, then it's going to be a problem. Okay, I'll be waiting for your text. Okay, now, great, perfect, wonderful. So again, I'm selling 2 units. Okay, I'm just gonna summarize it. Okay, got you, Christian. Maybe some issue with video distribution network. No idea. Okay, got you. Perfect. Something happened. Not sure what it was. Again, I guess YouTube is not perfect either. Anyway, so summary. I'm selling 2 of the 35 puts, so I can close the 35 put and long and sell 1. So I end up net short 1. Sorry, that's what I'm emulating. Notice the date I'm selecting here is April 22nd. And I'm doing the same with the 40 put, with the 40 call. I'm selling 2. Okay, so if I do that, okay, if I do all of this, okay, this is gonna basically provide me with what I need. Okay, now the other thing I want to add to this equation is that the 14 April expiration options, the 40 call and the 35 put, those have provided 70 cents and 60 cents of premium And one easy way for me to get rid of those roles so it's a bit less confusing, it's just to take the cost of the original trade, which is 110 for the call, minus the 70 cents that the call provided when I've been selling them, those two figures. I do the subtraction, that's 40 cents, and that allows me now to type here 0.4 and basically get rid of the short April 14. So we don't have April 14 in the equation. Okay, so I can simulate all the way to April 22nd. Same thing with a put. I paid 90, but I got paid 60. So my net cost is 30. Okay, so I can get rid of this one, and now I'm fine. So in other words, if I'm long the 40 call and the 35 put, April 22nd, at those prices, which is the net P&L of the trade at this moment, and I sell two of each against, so I basically take the long position, the long straddle, long strangle, and I now make it short strangle. Okay, that's what I've done. So the one thing left to do is to now take two buy orders using April 29, where now I'm going to buy the April 29 40 call and buy the April 29 35 put. Okay, so by doing that, I end up with long the call 40, long the put 35, short the call 40, short the put 35, with two different expiration dates, which is 29 and 22. 29 being the date for the expiration, so if there is a rise in implied volatility, I will benefit from that. And 22nd, okay, being the next expiration date, which, as we know, volatility is 30, is not that amazing. Okay, it's not that amazing, but the beauty is that I'm gonna sell the 22. The strikes are closer. I'm not doing 41 and 34. I'm doing 40 and 35. So the strikes are closer. So I get a bit more premium. And on top of that, because now I'm doing 22 of April, so then instead of the trade is over next week, now the trade will be extended by another week, and next week I'll sell another option. Okay, and that may help the net P&L of the trade. Okay, that's a pretty long story. Again, I'm very happy we are doing this because it's not a case that happens all the time. But that way you can see how it's done. Now, in this case, obviously, doing this, it's a terrible idea, okay? Because you can see now that my original risk of 60 becomes 205, okay? Again, if instead of having a frown, I had a volatility smile on the longer expiration date, so this may have worked, okay? It doesn't work that often, but it could work. And let's face it, if they change the expiration date, they change it, and basically they create a little bit of a mess for us. Again, the mess in the end, in our case, was you either end up with $17 of loss or $50 of profit. So mess is not like it's a big problem, but it kind of kills you, right? Because it's like, okay, you are just waiting for the earnings and you got that rise of volatility, and now they just pushed it, and therefore, it often creates that problem. Okay, so in this case, because we don't have that volatility smile on the volatility distribution, so really doing that is a terrible idea because we are quadrupling or 5 times more risk. This is completely crazy. It would make no sense to do this. Okay, so what if instead of doing this, okay, I'm just gonna get rid of the green and no need to compare the two options. What if instead of doing this with April 29, what if I do it with May 6? That was my other choice. Well, if I do it with May 6, it's gonna be different. Let's evaluate. Okay. So the risk of the trade is 235. The risk of the trade is more. I mean, we're not going to do it. Looks like the risk of the trade is going to be worse, 235. But to be honest, if I was to do it, I would do this one. Why? Because I'm going to sell April 22nd, but then I'm going to sell April 29, and then I'm going to say May 6. So that risk of 235 would shrink a lot, especially next week when selling the April 29, which is where the earnings are built in. So then the risk would shrink by a lot. But again, in both cases, instead of reducing the risk from 60 to less, we are increasing the risk by a lot. So it doesn't make sense. What killed us, one last time, is the fact, and I believe I closed it, yes. So I closed it. So I'm not going to open it again, we have no time. But basically, what killed us is the volatility graph that instead of showing us a beautiful smile, it was more like showing us a frown. And therefore, the options that are away from the at-the-money strike, they're not paying as much as what we need for this risk graph to be better. So what's my choice here? My choice is gonna go for lose 17 or make 50, because I'm in this trade ready, trade for weeks, ready to assume risk in exchange for reward. I'm not gonna give up on this trade and make 18 bucks now, because minus commissions is nothing. So what I'm gonna do is take that 35 put. But careful, I'm not gonna roll it to be 22nd 35 put. I'm gonna roll it to be 22nd 34 put. Okay, and here it seems that the rolling price is terribly low. Why is that? This is not what we simulated earlier, is it? Let me double check. Here's the option chain. HOG. So what do we have with April 14 and April 22nd? So we have 35 and 40. So the 35, yeah. The problem is that not having bid, the ask is terrible. Okay, so yeah, it's not looking too good. And the 40, the 40 is about the same. Okay, so when the action then here would be just wait until Monday and get those options for 15 cents in. Okay, that would be the way to do it, which is not ideal, but that would be the way to do it. So we cannot do the roll. We will need to wait for those options to expire, and then next week sell the new call and the new put. So let me place the orders into so you see how it's done. Obviously today we're going to be surpassed the ending time by a little bit. I'm sorry about that, even though I'm very happy we had this case in front of us, because it's not a common case and therefore we could talk about it. So in that sense, I'm very, very happy. I want to go ahead and emulate what would happen if we move this to be April 22nd. April 22nd, where everything is April 22nd. And instead of 40 call, it's going to be 41. And instead of 35, it's going to be 34. So if we do that, of course, we don't know how much we're going to get filled at, but let's pretend I'm going to get 15 cents. So 65 and 15, okay, that's 80. And 75 and 15, that's 90. Okay? So if that's the case, if I get 15 cents for each, so this is the new risk profile that you'll have with a maximum risk of 30 bucks in exchange for $70 of profit. Okay, if you could roll it today, it would be 17 versus 50, but it's going to be very difficult to roll it given the fact that we have missing quotes on the bid side. So I would just let it expire and do it on Monday. And if you don't get filled on Monday, just close the trade. Just close the trade, because then time decay is going to erode. And you will erode the trade very, very quickly, especially without the earnings report. The last week, the time decay is really going to kill the trade. So you do it on Monday quickly, or you don't. Okay? So let me place the orders in. So we're going to do April 22nd, HOG. We're going to be selling the 35 put at 15 cents. Good till cancel. Okay? Only on Monday, not today, because you would have double the puts. So Monday 18 09 35. Okay, let's do it. Send, yes. And then on the 40 call side, you could get your 15 already here. Okay, you could get your 15 already, but again, we are doing it today because we already have a call. So we'll do it. Good till on Monday. But then if you don't feel quickly in the initial part of the day, just close the trade. Okay, just close the trade, because time decay will go very quick here. So 18 09 35 00. Save, confirm, send. Okay, so that's it. I got my HOG trades waiting here. Okay, what else we have? We have one more trade to review, if I'm not mistaken. AMD, I believe. Okay, AMD. Yes, because LEN we closed that already. So AMD, same story. We are dealing with April 29, same type of trade. So I'm going to do this very quickly because it's the same approach. Okay, so that stock has been moving a lot. Okay, that stock has been moving a lot. So one of the options is going to be in the money. Okay, that may have an effect on distorting the Greeks later, but since today is equivalent to Friday because tomorrow market is closed, so that's probably good enough for us to do the roll. So let's evaluate. So we are talking about AMD. We are talking about April 22nd and April 14. We are looking at AMD here still being within the range, even though it's moved a lot to the downside from 112 or something like that all the way to 95. That's a pretty interesting move. So we are below 103. 95 is below 103, so we are deep in the money. Okay, so let's take a look at what's happening to those Greeks. Okay, so it's 124 and 103. So 124 and 103. So 3, 124. So what do we get? 124 pays nothing. Okay, so this one is going to be very disappointing. The 103 pays a lot. Okay, but the question is not that. Is that a lot is because it's in the money, right? So the question is, what do we get on the 103 on the 14th of April? Okay, well, theta shows 11 cents. Okay, the current amount of extrinsic value is, if you do the math, so the midpoint between 7.5 and 7.40 is 7.45. That's the midpoint. The current price of the stock is 95.55, and we are dealing with the 103 strike. So that is 103 strike minus 95.51. That is 7.49. Okay, 7.49 minus 7.45 tells you that there is an extrinsic value there of 4 cents, where theta shows 2. Okay, so actually the Greeks are not distorted yet there. Okay, by 2 cents. Theta tells you you're going to make 2 cents. The reality is that you still have 4 cents available of theta. So, you will want to wait a little later, maybe 1 hour later, that's it. Okay, but I'm going to do it now, obviously. Okay, so you will want to roll the 103, okay, on AMD. So the 103 on AMD right here, let's roll it. Okay, to April 22nd. It's going to provide 52 cents of credit. So let's do it. Okay, I'm just going to force it. It's late. Please do not do that. When I use market orders in the sessions, it's just to speed up the field so I can be more demonstrative, if you wish, but never trade options, especially spreads with market orders. I would be crazy. Look at that. I got 40 instead of 52. I got killed there on a terrible price. Doesn't matter to me, but it would matter to you if it's a real account, isn't it? So keep that in mind. So basically, we paid 7.55, collected 7.90, so we added 40 cents to our trade. So in other words, this trade is now looking like this. Oh, sorry, not like that. It's a trade where the 103 using April 22nd has 40 cents, I said, right? Yes, 40 cents more. So instead of 2.54, now it's 2.94. Okay. And on the call side, the idea is to try to get 15. Okay. So if I was to get 15 later in, so that's going to be 71. Okay. And if that was possible, so okay, the new risk profile like that, where the risk has been reduced. Same story. When volatility rises, okay, you're gonna be in business, okay. Depending on how much volatility rises, even if the stock has moved so much, you may end up in the green. And again, we are simulating until April 22, which is not significant yet because we're going to be doing the trade, all the way until April 29. So this risk profile will improve next week. But anyway, I'm just going to copy and paste that on our positions panel so we can track it in the following week. I have to place the 124 call order. Okay, I can do it right now because I don't have the call, so I can do it right now. So that is AMD using April 22. We're gonna use the 124 call. We want at least 15 cents. This is not gonna be possible unless the stock rallies. This one I don't need to wait until Monday because we don't have the calls. Do it now. So I'm just doing good till cancel. So whenever it happens before its expiration, I'm gonna get filled at that price. Okay, so the orders are in, the managements are done. I'm good to go. Now let's keep going. With what the market has to offer in next week. Sorry for rushing a little bit. We're concluding the session, but obviously we are ending late. I didn't want to miss AMD, so I had to rush a little bit here. Okay. Anyway, lots of things today, guys. Any questions? Any comments? How is it going? All good. Was I too fast for you today? I'm actually very happy about what we saw with HOG, even though we had a frown instead of a smile. But from a practical application of things that will happen, it's a good one because earning dates are not static. Okay, so this is a great lesson to learn today. Joe, we took care of GE earlier. So what I'll do for you, I'll put it on the chat box. Just bear with me 1 second. Give me a moment. I'm trying to do this quick. So then you can go ahead and take a look with no rush. Because normally recordings are posted, around 24 hours later, isn't it? So I'm just sharing with you here in the chat box the direct link to this stream. So after the session is over, you can just click on that link, okay, and go watch it from the beginning because you don't need to wait until tomorrow if you have this link. So now you have it, okay, Joe? And the GE explanation is there. Okay, Mark, yes, I would love to see that. Thank you for that. Great session for that. Thank you for that, Ahmed. And great session to you as well, guys. I saw some action there. Christian, very well done, being on top of those trades earlier in the week, doing those rolls. Everyone, thank you for being engaged and collaborating and participating and engaging with me and discussing all of this together. And let's keep going. Okay, let's keep going. Tomorrow you have Josip. Okay, so don't miss it. It's gonna be another great session with him. Don't miss it. Okay, see you. Bye bye. Take care, my friends. Bye bye. See you soon.